Hi everyone, I'm Shekhar from Smart Money. And in this video, I'll talk about how do we backtest an absolute momentum strategy using Google Sheets. Backtesting is a process in which we test out a trading idea in the historical context. And if the trading idea can be represented in a mathematical format, then that's it. We can easily backtest any trading idea and come to a conclusion whether this idea is worthwhile to pursue or not. Absolute momentum refers to a strategy in which we are concerned about a stock's performance against its own historical data. So absolute momentum strategy does not bother about any other asset classes or any other asset prices. We're only worried about its own historical performance. And if the historical performance is good, then we go ahead and invest in that stock. Now, how do we define a good historical performance? There are a couple of benchmarks. One benchmark is we could use its own exponential moving average and come to a conclusion. If let's say the stock's price is closing above the exponential moving averages, then we can go long into that stock. The second way is to compare against its own ATR, average to range, and go long in the stock based on the ATR levels. And thirdly, we can also compare against a fixed deposit interest rate, for example. Maybe let's say if the FD rate is around 6.5%, and if in the last 1 year, if the stock's performance is more than 6.5%, then we could go long in that stock. I'm going to use an exponential moving average method. So here are the details. I'm taking NIFTYBEES as the security, and NIFTYBEES is a ETF which represents the Nifty 50 index. It's a well-diversified index. And the mathematical expression of my idea is if NIFTYBEES closing price at the end of the day, if it's greater than the 200-day exponential moving averages, then I'm going long, or in other words, I'm going to buy that stock. If NIFTYBEES closing price is less than or equal to 200-day exponential moving average, then I'm going to hold. I'm not going to sell. I'm just going to hold that. I'm going to hold till, again, a new long scenario comes into picture. So that is, in simple words, my idea. And I've taken last 10 years of data for this analysis. Now I'm going to use this strategy to compare against a benchmark. Now the benchmark for me will be NIFTYBEES. NIFTYBEES in a buy and hold strategy. So I'm going to compare a buy and hold strategy of NIFTYBEES versus our absolute momentum of NIFTYBEES. And the absolute momentum I've defined as if the closing price of NIFTYBEES is greater than 200-day moving average, I'm going to buy. If the closing price of NIFTYBEES is less than or equal to 200-day moving average, then I'm going to hold. Let me share my Google Sheet and show you step by step how do we do this backtesting. So I'm going to build this backtesting strategy alongside with you. So at any point of time, if you want to pause and take a deeper look at it, you can always do that. So there are 4 parts in any backtesting strategy. The first part is getting the raw data. Second part is in generating the signal. And third part is in doing the analysis of the strategy. And fourth part is getting the data for benchmark, because we need to compare our strategy against the benchmark, right? So these are the 4 different parts. So to get the raw data, I'll use Google Finance function. So let me write down the Google Finance function equal to NIFTYBEES. The attribute is price. And the start date, I'll exactly take 10 years back date, which is 2014-05-21. And the closing day will be today. And I want daily data. I think today needs to be braces, yeah. All right, we got the 10 years data of NIFTYBEES. Let me quickly check that. Yeah, it seems legit. Then let me now calculate the exponential moving average. The function or the calculation for exponential moving average requires EMA factor. And EMA factor is nothing but equal to 2 divided by the number of days that we want an exponential moving average divided by, yeah. So this is the EMF factor. Let me quickly recap that. Equals to 2 divided by the number of days in which we want the exponential moving average plus 1. So let's say if you want a 40-day moving average, the value changes. If you want a 200-day moving average, the value changes. Now, how do we use this exponential moving average factor? I'll come to that. So first, what we need to do is we need to calculate the simple moving average of the 200th day. Simple moving average of the 200th day. Let me come down to the 200th row. Give me a second. Right. So this 200th day will be simple moving average. Let me change the percentage to number format. Yeah. Now the 201st day record, for that, how will we calculate 200 EMA is equal to yesterday's EMA plus the difference of today's closing price minus the yesterday's EMA multiplied by the EMA factor. So you can copy paste this formula, and this EMA factor needs to be frozen so that we can drag it till the end. Got it. So this is the EMA for all the days. Now let me calculate the daily returns. For daily returns, use a simple formula equal to today's price minus yesterday's price divided by yesterday's price, and I'll change it into percentage format. Now we got the daily returns. So these 4 are raw data that we'll use to generate a signal. Signal is, so for us, the signal is if the close is greater than 200 EMA, buy. If the close is less than or equal to 200 EMA, hold. So since the 200 EMA starts from this row onwards, so our signal also will start from this row. So the formula will be equal to if today's closing price is greater than today's 200-day EMA, then go long. Some people use long and some people use buy. Both mean the same. I'm going to use long. And if it is not long, then hold. So that is the condition. Let me autofill it. Okay, so this is the condition. Take a look at it. If the today's close price is greater than today's EMA, then it is long, else hold. To cross check, let me go and see a condition where it is hold. Okay. On this day, it gave a signal of hold. Let me validate the numbers. The closing price is 82.43, which should be less than the EMA, 82.83. Yes, it is. So the signal is genuine. Now let me also calculate the count or the number of times this signal was given, because we also need to keep a track of the number of transactions that we do, because for any strategy, if the number of transactions are abnormally high, then the strategy might not be worthwhile to pursue. Only if it is reasonably low, then we can do that. So how do I do that? So if today's value is same as yesterday's value, I count it as 0. If not, I count it as 1. Let me double click that. Okay. So when all right. So I got 53 times an entry signal. In how many days? In total, 2,261 days. So that's a pretty low number. So let me color these two as green, and to denote that signals are different from the raw data. Now, once I get this signal, I need to build the data for my strategy. NAV is a method in which it helps us calculate the returns over a period of time. And we use this NAV method again for benchmark to judge between our strategy and the benchmark. So let me assume that I'm starting with 100 rupees on the day 16th March 2015, before any signal was given, just one day before the signal was given. If yesterday's signal was long, then I'm going to buy the stock. If yesterday's signal is not long, then I'm going to carry forward yesterday's money. So if you notice, this is the formula equal to if E202 equal to long. So yesterday there was no signal. Since there was no signal of long, the amount of money that I'm carrying forward in today is the same as yesterday's. Let's see what happens the next day. The next day value changes because I got a long signal yesterday equal to if 203 equal to long. If yesterday the signal was long at the end of the day, then I'm going to buy NIFTYBEES today. And if I'm going to buy NIFTYBEES today, I'll get the returns of today's. So that's why I'm going to multiply the value that I'm carry forwarding with the returns of today. So the key assumption here is the yesterday's closing price is the same as today morning's opening price. That is a key assumption that this model takes into consideration. It is a valid assumption because not all days we have a gap up or a gap down. More or less, the trend is smooth. So that assumption, if we take into consideration, then today's returns are going to be yesterday's value multiplied by today's returns. Now let me double click it and get the total values. To do a cross check, let us go to a scenario where the signal is hold and compare the returns. All right, on 27th of April, we got a signal of hold. So if we got a hold signal, then we should be checking next day's NAV. So what does the next day's NAV says? If E229 equal to long, which means yesterday's signal is equal to long, then multiply yesterday's value with today's returns. If it is not long, then carry forward yesterday's NAV. So let's see what is the NAV of today. It is same as yesterday's. So it means the NAV is working perfectly in both the scenarios when it is long as well as hold. Let me come down to the final NAV to just check if it is reasonable or not. Yeah, looks genuine. Cool. Let's move up. Then the next step that we're going to calculate is we're going to calculate the weekly change, or sorry, daily change of our returns. Let's start from this day onwards. Let me convert that into percentage. Also, we got the daily change as well. Now, after I get the daily change, what I'm going to do is I'm going to calculate max NAV. So this max NAV function, how it works is it helps me in calculating the drawdown. So that's why I'm going to use this max NAV. So what I'm going to do is equal to max yesterday's value and compare it with today's NAV. So if you see the function, sorry, let me double click this and show you the function. So yesterday I started out with 100 rupees and today also it is still 100 because I did not get a long scenario. So the max of yesterday's amount and today's NAV, since both are same, I get 100 as max NAV. But next day I got a long signal, so I went long. I purchased NIFTYBEES, but unfortunately I got negative returns of minus 0.42% and hence my NAV ended up at 99.6. Now, how does this max NAV function work? So max NAV compares today's NAV with yesterday's max NAV. Amongst 100 and 99.6, 100 is the highest, so I still get 100. Now, the reason I calculate max NAV is because I want to compare the difference between the least value of my NAV versus its previous highest NAV. So as you go down, you see that as long as we are below 100, the max NAV doesn't change. The moment max NAV is above 100 and 100, let's say it moved to 100.4, our max NAV again changed. So that's the max NAV formula. I think it will be easily understood once I apply the drawdown calculation. Drawdown percentage. So drawdown percentage is NAV divided by max NAV minus 1. All right. So as you see, in the initial days when I invested 100 rupees into my strategy, the index was falling quite a lot. It went to a minimum of 96. So on the day when it went 96, my drawdown was showing as minus 4%. The drawdown was gradually increasing as the NAV was falling down. And once the NAV started to recover from 96 to 97 and 98, the drawdown started to decrease. So that is the use case of drawdown percentage formula. So in this duration, the max drawdown was on this day, 27 March, that was at minus 4.02%. So that's the objective of drawdown. We got all the important analysis that we need to compare our strategy. Let me add a couple of more data points. Let me calculate 1 year rolling returns, 3-year rolling returns, and 5-year rolling returns. So I need to compare the rolling returns of 1 year, 3-year, and 5-year. I'll tell you why I need the rolling returns of 1 year, 3-year, and 5-year. Before that, let me first calculate the absolute returns of this strategy. Absolute return. Absolute return is nothing but the final price divided by the initial price. Initial price is NA 100 minus 1. Let me convert that into a percentage. It is 138.54%. So our strategy gave a returns of 138.54. But as I mentioned, the absolute returns are meaningless because it doesn't take into consideration the duration. So if someone is saying that I got a returns of 100%, we always need to ask whether that 100% was achieved in 1 year, 1 month, 1 day, or what time frame. So let me calculate the time frame by seeing the difference from the end date and the start date. The start date is 17th March 2015. So we had 3,349 data points over which this strategy was running. So to calculate CAGR, we'll use the final price divided by the initial price, raised to the power of 365 divided by this number minus 1. So I'm calculating CAGR. CAGR gives the annualized returns. Annualized returns are much better to compare. It gives you a context. So this number 9.94% is on an average, our portfolio grew by 10% year on year over the last 10 years. That's what this strategy says. Now, the problem that I have with CAGR is that it only gives the data between the first point and last point. But to test the robustness of a strategy, we need to compare the annual returns between multiple such initial and end points, which are separated by 365 days. So in a 10-year window, what I'll do is, let's say you enter randomly on any given day and you hold the strategy for 1 year. What are your returns are going to look like? So I'm going to calculate using rolling returns. So rolling returns is, let's say, this is 3349 minus 365. So the way I calculate rolling returns is, I have 2463 records, and I'm going to subtract 365 days. So what I'm going to do is, I'm going to calculate today's data divided by G2098. That is exactly 1 year back in NAV. So this will give me 1 year return if at all I had started exactly 1 year back from 17th May 2024. That is, if I started on 17th May 2023, my returns would be 23.23. Now, what if I started on 16th May 2023? My returns would have been 23.38. What if I did start on 15th May 2023? Then it would have been 21.67. So as you can see, every day has its own returns profile across this 10-year period. Now, I would like to calculate the average of all such 1-year returns throughout this journey, throughout this 3,300 days ka data. So let me pull that way back up and see what is the return profile looking like. So if you get this reference, it means that there is no record. So we can easily delete it from these numbers. Now I got data of all 1-year returns. So let me calculate the rolling return of 1 year. Just nothing but the average of all such 1-year returns. Now, if you see, the picture has changed. So the 1-year rolling returns are way different than CAGR. Let me do the same exercise for 3-year rolling and 5-year rolling returns. Look at cool. So we got 1 year, 3-year, and 5-year rolling returns. These are much better ways to compare strategy than the CAGR, because CAGR takes into consideration only the start and end point and doesn't take into consideration the multiple points in between, because a retail investor would not necessarily come and invest on the exact start date and the end date. They might come at any point of time in between and exit any point of time in between. So if, let's say, someone comes in and stays exactly for 1 year or maybe 3 years or maybe 5 years, what would their returns would look like? So if someone would want to check that number, then 1 year, 3-year, and 5-year rolling returns would be a better way to calculate them. Now, let me quickly do the same strategy, same calculations for the benchmark. As if you were to, let's say, buy and hold NIFTYBEES on the same day as we started our strategy, then it would simply be equal to 100 multiplied by the next day's returns. Don't have to apply any calculations further. So let me cross check that, equal to N202 into 1 plus. Yes, so this is the daily returns. Let me drag that. We're going to compare the Nifty returns. So we're going to compare our returns with this strategy. And we'll go 800. So this is how the returns will look like in absolute terms, 185.99%, much better than the absolute returns. But also let's compare the CAGR, which is nothing but equal to and we'll need to annualize by dividing the number of years. So the annualized return are around 12.13, whereas for us it is around 10% in our strategy. Now let me also calculate 1 year, 3-year, and 5-year rolling returns. So before I do that, I need the NAV and daily change of NIFTYBEES. So it's the same way that I'm going to use for Nifty. So I can use the same formula and just copy paste it. All right, done. So that has given me the data for NIFTYBEES. So I'll use this data to calculate the benchmark returns. So I've shown you the CAGR and the absolute return. Now let me calculate 1-year rolling returns, which is the average of all such 1-year returns that were possible during this time frame. And for 3-year rolling period, equal to average, I'll use 3-year return and For the 5 years, we're going to use the 5-year rolling return. Now, if you look at the returns, obviously Nifty as a buy and hold strategy performs better than the Nifty absolute momentum strategy by 2 percentage points. And 2 percentage points over a period of 10 years is not a small number. It definitely amounts to a big difference, as you can see in the absolute returns. We also need to compare not just the returns, but also the risk that we're going to take in both of the strategies. If your strategy is having a lesser drawdown, then it means that it is taking lesser risk. So let me calculate what is the maximum drawdown that our strategy has endured. So our strategy had endured a maximum drawdown of 20% for the last 10 years. Let me do the same thing for Nifty. That is, we take min of all the drawdowns. So as you can see, the maximum drawdown that Nifty buy and hold strategy endured was minus 37%, which is way higher than max drawdown of the absolute momentum strategy. Now, if you calculate the ROMAD ratio, which is nothing but the returns to the max drawdown, returns divided by the max drawdown. From this point of view, this strategy looks better because it has a higher ROMAD ratio of 50% compared to Nifty. Actually, if you think about it as well, sitting through a drawdown of 36% is not an easy task. Many of the retailers would give up. And 20% drawdown is relatively easy for retail holders. So let me conclude this video by giving my final thoughts. I would like to plot the NAVs of the backtested model versus the Nifty buy and hold model. So the backtested model is in the blue color, whereas the Nifty buy and hold strategy is in the red color. As you can definitely see that the Nifty buy and hold has given a higher return, whereas the Nifty buy and hold strategy or the absolute momentum strategy has given a lesser returns, but also with lesser volatility. You can see that the red colored line is crisscrossing the blue line and has given a significant drawdown at multiple places, whereas the drawdown profile of the absolute momentum strategy is minimal. So the key takeaway from this video is that backtesting needs to be done to understand whether the trading idea or strategy fits into our investment psyche or not. And someone who's an aggressive investor might not like the strategy that we had presented just now. And if someone is like, let's say, a conservative investor who's more concerned about the drawdowns, might like the absolute momentum strategy. So taking into consideration different personas, we need to devise which is the best trading strategy for us. So that's all, guys, for this video. In coming videos, I'll be doing more backtesting models on relative momentum and as well as dual momentum. We'll also be exploring a couple of backtesting ideas on Python as well. So please stay tuned and do not take this as an investment advice. It is only for education and knowledge purpose. You can access this Google Sheet in the YouTube description.